portfolio managers and advisors of governments of his own generation. He's currently president of Queen's College in Cambridge and chief economic advisor of Alliance. He was previously the CEO and co-chief investment officer of PIMCO, one of the largest asset managers in the world, and chair of President Obama's Global Development Council. His book, When Markets Collide, was the New York Times and Wall Street Journal bestseller, and he won the Financial Times Goldman Sachs Business Book of the Year award. And he was named to Foreign Policy list of top 100 global thinkers for 4 years in a row. Mohamed, the floor is to you.
Thank you, Nouriel. And let me just start by saying what a privilege and an honor it is to be on the panel with friends and colleagues. And I want to thank Ambrosetti, as usual. You deliver a wonderful event. Now, there's a problem with coming last, which is that what I wanted to say has been said by people I respect and has been said much better than what I would have said. And not only that, but Jacob's beginning with the Jedi-like images really gave authority that I cannot possibly have. So Nouriel, I want to apologize to you because I told you what I was going to say, and I'm going to completely rip up that script and ask the question, what hasn't been said? And since we are dealing with investment risks, I am going to focus on a narrow element of investment risks, but one that's relevant to lots of people watching this. Whether you are a business that has to raise money and that worries about whether your consumers are going to be able to have mortgages, whether you are an investor in financial markets, what is really notable is that in the last few years, the really interesting things we have discussed have not really been relevant to markets. And that is particularly true in the last 12 to 18 months, even before the pandemic and since the pandemic. So I'm going to talk a little bit about this disconnect. And I take issue a little bit with what Jacob said, and I'll come back to it, because I think there's a third explanation. Let me go into this. And let me just say up front that there's lots of things I'm grateful about. I'm grateful about being on this event once again. I'm grateful about my family. I'm grateful about the health of my friends and colleagues. And I'm really grateful that I no longer manage other people's money. Because if I manage other people's money and I had my inclination of being led by fundamentals, by economic, institutional, social, and political issues, I would not have done well. And that is really important when you think about the risks and opportunities ahead. So what I'm going to do is say the following. If you want to understand what's been going on in markets, it is much less about fundamentals, and it is much more about two things that are evolving: the mindset of central banks and the conditioning of investors. And each of them are going through structural change, which means when we look forward, there's going to be some really interesting questions. So let me put this into context, going really quickly through past, present, and future. I'm going to pick up on 3 of the 6, I wrote them down 5 Ws that Jacob put forward, and call them the following: what, why, and so what. What has been happening in the last few years? What is a cumulative and significant confidence by investors, by corporations, that central banks will provide ample and predictable liquidity, large, and you can rely on it, you can bet on it. Why? Because central banks have stepped in once again and taken on an enormous burden, not by choice, but by necessity, and done so through the only way they can, which is operating through the financial asset channel. So we all know what it looks like. Very, very low interest rates, negative in the case of the ECB, massive purchases of securities, and very aggressive forward policy guidance. longer, lower for longer. We are not going anywhere in terms of our support for financial markets. That's the why. The so what is very simple. If that is your reality, and the marketplace understood that that is what your reality, and companies understood is that what their reality, you ride this liquidity wave. You become a surfer. And it's really enjoyable because the wave is stable and big. This is what we've been there, and it conditions people to behave in certain ways. It conditions companies to assume that low interest rates are here forever. So is ample provision of funds if you can access the capital markets. And of course, it conditions investors to believe in three things. Tina, there is no alternative to risk assets because they'll always go up. Buy the dip, because while everything that my colleague says is really interesting and they may cause some pullback, it will be very temporary because the liquidity is there. So buy that dip, regardless of why it's happening. And then FOMO, the fear of missing out on the next leg. What about now? No change in central banks. You saw this most visibly last week at the end of the Federal Reserve two-day meeting. Just think of how strange the outcome was. They aggressively revised up their growth rate for the US to 6.5%. They notably revised up their inflation projections to 2.5 for the core PCE to 2.6, and yet no change in policy whatsoever. If anything, they even stressed that they are no longer preemptive. They no longer look at forecasts, they're going to look at outcomes. And that is part of the change in the framework. So if you go forward, central banks are not going to get off the policy track they're on unless something big happens. The marketplace is starting to have doubt about not the continuity of central bank behavior, but the effectiveness of central bank behaviors. And this year alone, we've seen a significant increase in yields, which shouldn't happen if central banks, and the Fed in particular, is buying 120 billion of assets every single month and tells us it's going to continue to do so, and yet yields have moved significantly. Inflationary expectations have moved, as both Moses and Jacob reminded us. Don't forget about that issue. We've had two near accidents in liquidity, and the buy the dip behavior is still there, but not quite as strong. So what we've had is a different outcome in markets, which is instead of markets simply embracing the liquidity paradigm, it's been price action in search of a unifying and deterministic narrative. That's where we are today. Finally, the futures. Two questions. If you want to be a successful investor today, you are informed by what you've heard, but you don't act on that. You don't act on what my brilliant colleagues have said because your starting conditions are very different. You act on two judgments. What will the central banks do? So you have to get inside the mindset of the central banks. And how will market conditionings evolve? So you have to get into the psychology of the marketplace. Now, the Fed is going to be related to this really important debate about inflation. I'm going to come back to it in the next panel that I have the privilege of being on. The market psychology is wide open. I don't know. That's why I go back to, I'm really glad I'm not managing other people's money. We don't know how this liquidity obsession is going to evolve. But there are certain implications, and that's where I'm going to end, Nouriel. First, the past was all about one factor and top-down positioning. If you were a passive investor and you simply said, I don't know, I'm going to go across the indices. Yes, you would have done better in the NASDAQ than you would have done in the Dow, but you know what? You would have been up across the board. You would have been even up in risk-free assets. This year, emerging markets are doing as well as the S&P. This is going to change. Now we're going to need much more emphasis on bottom-up, granular, very detailed balance sheet and management analysis. Outperforming is going to go from passive management to much more active management. And finally, behavioral issues are going to be much more important. So please have a behavioral finance person or behavioral scientist next to you, because that's going to be critical. Thank you.
Thank you very much, Mohamed. You stressed the key interaction between central banks and investors and market participants. And as we know, for the last few weeks, there has been this tug of war between investors saying, I'm starting to worry about overheating of the economy, especially in the US, given the monetary, fiscal, and the credit stimulus, and that has pushed long rates higher, threatening the recovery of risky assets like US and global equities and the greater inflationary rotation. And on the other side, Fed telling us, don't worry about it, any increase in inflation is going to be temporary, and a small overshoot of inflation is not going to lead to the anchoring of inflation expectation. The markets are not convinced by what the Fed is saying. The Fed keeps on reiterating, and I think that tug of war is going to continue. It's going to be one of the key issues that's going to affect then, especially this year, what's going to happen to global risky assets like equities as well. So we've done a great first round of presentation and commentary. We're going to go to the Q&A, but before we're going to go to the Q&A,